Swamiye Sharanamayappu. Hi students, how are you all? So to jump into practical classes of Tally, you must know grassroots theory of that concept. You must know and have a strong command over journal entry, ledger, trial balance and so on. I again recommend every non-commerce students to not to skip any part. First of all, you should have a strong command over basic terminology used in commerce to pass a basic journal entry. So, to my satisfaction, I will teach you about some most important terminology used in most of basic journal entries. So, always think in point of view of business and consider and understand business transaction in business point of view, never ever in customer point of view. So first term we will learn here is purchase. When you buy goods, we mark the transaction as purchase. It only deals in goods, not asset. Goods means our business product or item. Our next terminology is sale. When we sell goods, we mark the transaction as sale. Our third accounting terminology term is purchase return. When you return back the goods from whom we have bought, here you refers to business and we are returning to manufacturer. Now next term is sales return. When customer return backs the good, may be defective, to you refers to business. Now next accounting term is debtor. Person who have to still pay you back money. Person who bought mainly cash or goods from us on credit. Credit means like loan. Now next accounting term is creditor. Person to whom we or business had to give back money to them took on credit. Next is liability. Money owed to outsiders or creditor. Example, bank loan. Next, asset. Asset are valuable resources of company which yield economic benefit to us like plant and machinery, land, etc. So, this is the format of a journal entry. See, left side is always written as debit, right side is always credit, and asset and expenses are always debited in a journal entry and liability and income are always credited. Now, please mark this as important in your notebook and write this golden rule what I am telling you. Asset when increases will always be debited in a journal entry. Asset when it is reduced, it is always credited. Liability when it is added in our business, it is credited. Liability when it is reduced, it is debited. Expense when added is debited. Expense when less, it is credited. Income when it is less, it is debited. Income when it is added, it is credited. It is because asset and expense is having a debit balance and it is always debited, so when it increases we debit it, and when liability and income is credited when it is increased because it is having a credit balance. So these are three main golden rules for personal account, for real account, for nominal account. In personal account, debit the receiver, credit is the giver. In real account, debit is what comes in, credit is what goes out. Nominal account, debit is all asset and expenses, credit are all liabilities and incomes. Like if I bought a machinery, every transaction will have or affect two accounts known as dual effect principle. So just memorize your terminology while passing a journal entry. So if the transaction is like if I bought a machinery, so when you buy a machinery, asset is increasing and cash is decreasing. So just memorizing above what I taught you, when asset increased debited, when asset is decreased it is credited. So when machinery is coming in our business, it is debit balance for us, as debit is as asset is increasing, as machinery is increasing, and cash will be credited as cash a asset is decreasing. So our journal entry will be machinery account debit to cash account. The first line of a journal entry will always be debit line, and second line will always be credit line. So, and we have to write in first line DR known as debit, and in credit line we have to write TO2, and we have to write after every business accounting terminology A bar C known as account, and we have to read as account also, and we will study more about of this in next chapter ledger. Okay, so now all of you open a fresh page in your Tally notebook and pause this video and write this full-fledged question in your notebook. For commerce students, do this question and solve the question given in description box. As to keep the video short, I can only do one question in detail here. So maybe solve this question. So draw proper journal entry format as I have told you. Now in date column write the year and month and write on first. So reading the question, Anand commenced business with cash. Okay, so which accounts are reflected here? Cash and capital. Capital is amount invested by owners. Okay, so as we have learned, when asset increases, it will be debited. When liability or capital increases, it will be credited. Okay, so when passing the journal entry, we have to write, and its journal entry is cash account debit to capital account. Amount 50,000. Okay, on second opened a bank account. Okay, so some may think it will be bank to capital, but no, it is not introduced by owner. Okay, and it is not on opening date. So we have opened a bank account by depositing cash. Okay, so we have learned that when asset is increased it is debit, and when asset is decreased it is credit. Okay, so the accounts reflecting here are bank and cash. So bank is increasing and cash is decreasing. So bank account debit to cash account 15,000. Now on 3rd of July we have bought an office furniture. Okay, so accounts reflecting here are furniture and cash. Of course, we have bought office furniture by cash. Okay, so office furniture and asset is increasing in our business, and cash and asset is decreasing. So office furniture account debit to cash account amount 4,000. 4th July. On 4th July, we have bought a machinery from Kirloskar Co. Okay, so in this transaction, Nowhere it is mentioned that we have bought machinery from cash. So in default, when it is not mentioned, we assume it to be credit transaction. Credit means loan. Okay, so our creditor is a liability for us and we have bought a machinery. So accounts reflecting here are machinery and creditor. Creditor is our Kirloskar Co. So machinery is increasing and creditor is increasing. So machinery account to Kirloskar account. Now on the same date we have paid for carriage. Carriage is an expense. Okay, so two accounts reflecting here are carriage and cash. Okay, so our expense is increasing and the next is increasing. So carriage account debit to cash account. On 5th, bought goods from Thomas and Co. 12,000. So always mark when in transaction it is written or the word is used from means he will be a creditor in most of the cases. When it is marked or in the transaction the word to is written, it will be a debtor. Okay, so now the word from is used, so here he should be a creditor. Okay, so we have bought goods from Thomas and Co. and cash word is not mentioned, so we have to assume that it is a credit transaction. So the accounts reflected are goods and Thomas and Co. So our goods have been increased and our creditor has been increased. So journal entry will be goods account debit to Thomas and Co. 12,000. And on the same date cash sales 5,500. Cash sales means we have got cash by a sale or many sales. Okay, so the two accounts reflected here are cash and sales. So our cash and asset is increasing by sale and sales and income is increasing. So we have to debit cash and credit the sales. So journal entry will be cash account debit to sales account 5,500. And on 6th, sold goods on credit to Ramesh 2,715. So we have sold a goods to somebody and it is on credit. So think about it. He will be a creditor or a debtor? Of course, he will be a debtor. And the word to is also used here. So our debtor has been increased and we got income and our income has also been increased. So debtor, which is Ramesh, who is Ramesh? So debit Ramesh. Ramesh account debit to sales account 2,750. And on the same date bought goods from Menon and Co. 750. So up to now I was assuming that you don't know anything about journal entry. So I was teaching very slowly from grassroots. So now I will speed up. And on 7 paid wages. Wages have been paid by cash. So two effect reflected here are wages account and cash account. So our expense, which is wages, is increasing and our cash is decreasing. Okay, so wages account debit to cash account where wages have been or expense have been increased and cash have been or asset have been decreased 500. And on 8th return goods to Thomas and Co 1,200. So here we have returned goods to Thomas and we can see from above 5th transaction Thomas and Co was our creditor. Okay, now we business are returning back to him. So it is a purchase return. Okay, so purchase return is always credited and sales return is always debited. Okay, so two accounts reflected here are Thomas and Co and purchase return. Okay, so transaction will be or journal entry will be Thomas and Co account debit to purchase return 1200 and on 9th paid sundry expenses. Okay, accounts reflected here are sundry expenses and cash. Okay, expenses have been increased and asset have been decreased, so sundry expenses account debit to cash account 200 and on 10th stationery article purchased for cash 240. Okay, so transaction affected here are stationery and cash. Okay, so our expenses have been increased and our cash have been decreased, so journal entry will be stationery account debit to cash account 240 and on 10th receive goods returned by Ramesh. On 6th date we can see Ramesh was our debtor. Okay, so we should have debited him and here and if we are returning back we have to make it credit to settle off. So accounts reflected here are sales return and Ramesh. Sales return is always debited, so sales return account debit to Ramesh 275. Ramesh is credited because debtor has been reduced or our asset have been reduced and on 11th paid cash to Thomas and Co 6500. So from 5th transaction we know he was a creditor for us. Okay, and on 11th if we are paying cash to him we are decreasing our liability and decreasing our asset. So liability here refers to a creditor. So our creditor is decreasing and our asset is being decreasing. So Thomas and Co account debit to cash account 6500 and on 13 cash received from Ramesh 1500. Okay, so cash and asset is coming in the business or our asset is being increasing. Okay, so cash account debit to Ramesh account 1500 and on 17th, oh I forgot to tell you, you can see the date 6th Ramesh was our debtor, so when he pays us cash, debtor which was an asset have been reduced, so he is being credited. And on 17 purchase goods from Sangi for cash 2500. So can you tell which are the two accounts reflected in this video? Okay, so two accounts reflected in this video are purchase account and cash account. Sorry, it was not Sangi account, okay, or not goods account, okay, because it was a cash transaction, not credit. So Sangi and Co was not a debtor or creditor for us, and we were not dealing in any asset, it was regular goods. Okay, so purchase account to cash account 2500 and on 19th bought typewriter for office use 2750. So typewriter is an asset which have been increased and cash and asset have been decreased, so typewriter account debit to cash account 2750 and on 21st paid electricity charges 140. So electricity charge and an expense is being increased and cash and asset have been decreased, so electricity charges account debit to cash account 140 and on 23 paid into bank 5000. So when we are paying into bank it means we are depositing cash in bank, so bank and asset have been increased, cash and asset have been decreased, so bank account debit to cash account 5,000. And on 25th, advertisement charges paid 50. Okay, so advertisement charges is an expense for us which have been increased, and cash and asset have been decreased. So advertisement account debit to cash account 50 50. 27. Introduced further capital by Anand 10,000. So accounts reflecting here cash and capital. Okay, so cash have been increased, or an asset have been increased, and a capital have been increased. So asset is an debit balance when it increases, and credit and capital when increases is a credit balance. Okay, so capital account cash account debit to capital account 10,000. And on 29th, paid commission for salesman for the month 850. Okay, so commission as an expense, we have to debit it, and our cash has been gone or asset have been reduced, so commission account debit to cash account 850. And on 31st, paid salary to staff 550, paid rent 2,500, paid insurance premium 580. These are all have been passed in same date, so we can pass a combined journal entry like paid salary to staff. So salary as an expense have been increased, and we as cash and asset have been reduced. So journal entry will be salary to cash, paid rent to cash, paid insurance premium to cash. So as a combined journal entry, we can write salary account debit, rent account debit, insurance account debit all together to cash account 3,630. Now to keep the video short, we have some limitation. Now try to do rest 4 question self and check it with the answer which I have uploaded in the description box, and the question is also scanned and available in the description box. Thank you.